Have you ever wondered what really drives mortgage rates and why experts are saying they might finally start to ease next year? Let's write down what's going on behind those numbers you keep hearing about, mortgage rates, and why things might actually be looking up as we head into 2026. To start, here's something that's been true for over 50 years. Mortgage rates tend to move right alongside the 10-year Treasury yield. Basically, when the yield goes up, mortgage rates follow, and when it drops, rates usually come down too. The 10-year Treasury yield is like the heartbeat of long-term borrowing costs in our economy. Now, here's where it gets interesting. There's something called the spread, which is the gap between mortgage rates and the Treasury yield. Normally, that spread sits at around 1.76 percentage points, but lately it's been much wider. And the wider spread is often a sign of uncertainty in the economy. When lenders feel cautious, they bump up rates to protect themselves. The good news is that spread is finally starting to shrink. That means lenders are becoming a little bit more confident, and when that happens, mortgage rates tend to ease. Redfin recently explained it perfectly. When the spread goes down, mortgage rates follow, and that's exactly what experts are watching right now. Here's another positive sign. The 10-year Treasury yield itself is expected to trend lower through 2025. So when you combine a lower yield with the shrinking spread, you get a 1-2 punch that could bring mortgage rates down further over the next year. If everything keeps moving this direction, we could even see rates dip into the high fives by late next year. Now, let's talk about what this means for us here in San Antonio. You might be surprised because even half a percentage point can make a big difference in your monthly payment. For buyers here in San Antonio, where rates have been hovering in a 6% range, a dip into the low sixes or even the high fives could open doors to homes that once felt just out of reach. And when rates fall, we tend to see a ripple effect across the market. Those buyers who've been waiting on the sidelines suddenly start jumping back in, which boosts demand and helps move inventory. That kind of activity keeps the market healthy and creates opportunity on both sides of the table. Sellers also benefit when rates ease. More demand means more competition, and that often helps prices hold steady or even rise slightly in neighborhoods where homes are already in high demand. For investors, lower rates can make the math work out much better. With reduced borrowing costs and steady rental demand, it becomes easier to secure cash flow or expand your portfolio strategically. And finally, timing really matters. San Antonio and South Texas continue to stand out for their strong fundamentals, steady population growth, a solid job market, and affordability compared to other metros. So if rates do ease, the key is to be ready. That means getting pre-qualified and positioned now so you can move quickly when the opportunity hits. So what should you do with this info? Start getting ready. Even if you're not planning to buy until next year, talk to a lender now. Check your credit, get pre-qualified. That way, when rates drop, you're ready to move. And if you're thinking of selling, this might be the time to start preparing so your home is ready to list when buyer activity picks back up. Here's the bottom line. Mortgage rates are showing signs of cooling, and that's good news for the San Antonio market. If you want to stay ahead of these changes and make smart moves while everyone else is waiting, let's connect. I'll help you understand what these numbers mean for your unique goals, whether you're buying, selling, or investing here in South Texas. Thanks for watching. Be sure to follow for more real estate updates and tips. I'll keep you posted as rates continue to shift, so you're always one step ahead.